Cryptocurrency is a digital payment system that doesn't rely on banks to verify transactions. It's a peer-to-peer system that can enable anyone anywhere to send and receive payments. Instead of being physical money carried around and exchanged in the real world, cryptocurrency payments exist purely as digital entries to an online database describing specific transactions. When you transfer cryptocurrency funds, the transactions are recorded in a public ledger. Cryptocurrency is stored in digital wallets. Cryptocurrency received its name because it uses encryption to verify transactions. This means advanced coding is involved in storing and transmitting cryptocurrency data between wallets and to public ledgers. The aim of encryption is to provide security and safety. The first cryptocurrency was Bitcoin, which was founded in 2009 and remains the best known today. Much of the interest in cryptocurrencies is to trade for profit, with speculators at times driving prices skyward. How does cryptocurrency work? Cryptocurrencies run on a distributed public ledger called blockchain, a record of all transactions updated and held by currency holders. Units of cryptocurrency are created through a process called mining, which involves using computer power to solve complicated mathematical problems that generate coins. Users can also buy the currencies from brokers, then store and spend them using cryptographic wallets. If you own cryptocurrency, you don't own anything tangible. What you own is a key that allows you to move a record or a unit of measure from one person to another without a trusted third party. Although Bitcoin has been since 2009, cryptocurrencies and applications of blockchain technology are still emerging in financial terms, and more uses are expected in the future. Transactions including bonds, stocks, and other financial assets could eventually be traded using the technology. Examples of cryptocurrency. There are thousands of cryptocurrencies. Some of the best known include Bitcoin, founded in 2009. Bitcoin was the first cryptocurrency and is still the most commonly traded. The currency was developed by Satoshi Nakamoto, widely believed to be a pseudonym for an individual or group of people whose precise identity remains unknown. Ethereum. Developed in 2015, Ethereum is a blockchain platform with its own cryptocurrency called Ether, ETH, or Ethereum. It is the most popular cryptocurrency after Bitcoin, Litecoin. This currency is most similar to Bitcoin, but has moved more quickly to develop new innovations, including faster payments and processes to allow more transactions. Ripple. Ripple is a distributed ledger system that was founded in 2012. Ripple can be used to track different kinds of transactions, not just cryptocurrency. The company behind it has worked with various banks and financial institutions. How to buy cryptocurrency. You may be wondering how to buy cryptocurrency safely. There are typically 3 steps involved. These are: Step 1. Choosing a platform. The first step is deciding which platform to use. Generally, you can choose between a traditional broker or dedicated cryptocurrency exchange. Traditional brokers. These are online brokers who offer ways to buy and sell cryptocurrency, as well as other financial assets like stocks, bonds, and ETFs. These platforms tend to offer lower trading costs but fewer crypto features. Cryptocurrency exchanges. There are many cryptocurrency exchanges to choose from, each offering different cryptocurrencies, wallet storage, interest-bearing account options, and more. Many exchanges charge asset-based fees. When comparing different platforms, consider which cryptocurrencies are on offer, what fees they charge, their security features, storage and withdrawal options, and any educational resources. Next step is to fund your account so you can begin trading. Most crypto exchanges allow users to purchase crypto using fiat, i.e., government-issued currencies such as the US dollar, the British pound, or the euro, using their debit or credit cards, although this varies by platform. Crypto purchases with credit cards are considered risky, and some exchanges don't support them. Some credit card companies don't allow crypto transactions either. This is because cryptocurrencies are highly volatile, and it is not advisable to risk going into debt or potentially paying high credit card transaction fees for certain assets. Some platforms will also accept ACH transfers and wire transfers. The accepted payment methods and time taken for deposits or withdrawals differ per platform. Equally, the time taken for deposits to clear varies by payment method. An important factor to consider is fees. These include potential deposit and withdrawal transaction fees plus trading fees. Fees will vary by payment method and platform, which is something to research at the outset. Step 3. Placing an order. You can place an order via your broker's or exchange's web or mobile platform. If you are planning to buy cryptocurrencies, you can do so by selecting Buy, choosing the order type, entering the amount of cryptocurrencies you want to purchase, and confirming the order. The same process applies to sell orders. There are also other ways to invest in crypto. These include payment services like PayPal, Cash App, and Venmo, which allow users to buy, sell, or hold cryptocurrencies. In addition, there are the following investment vehicles. Bitcoin trusts. You can buy shares of Bitcoin trusts with a regular brokerage account. These vehicles give retail investors exposure to crypto through the stock market. Bitcoin mutual funds. There are Bitcoin ETFs and Bitcoin mutual funds to choose from. Blockchain stocks or ETFs. You can also indirectly invest in crypto through blockchain companies that specialize in the technology behind crypto and crypto transactions. Alternatively, you can buy stocks or ETFs of companies that use blockchain technology. While cryptocurrency offers exciting opportunities, it also comes with real risks that every investor should understand before getting involved. 1. Volatility. Crypto prices can swing dramatically in a matter of hours. A coin worth thousands of dollars today could lose a significant portion of its value by tomorrow, driven by speculation, news, or even a single tweet from an influential figure. 2. Lack of regulation. Unlike traditional banking, most cryptocurrencies operate with little to no government oversight. This means fewer consumer protections. If something goes wrong, there's often no institution to appeal to for a refund or resolution. 3. Security threats. Digital wallets and exchanges can be targets for hackers. If a platform is breached or a user loses their private key, funds can be lost permanently with no way to recover them. 4. Irreversible transactions. Once a cryptocurrency transaction is confirmed on the blockchain, it cannot be undone. Sending funds to the wrong wallet address or falling for a scam often means the money is gone for good. 5. Scams and fraud. The crypto space has attracted fraudulent schemes, including fake exchanges, rug pulls, where developers abandon a project after collecting investor funds, and phishing attacks targeting wallet credentials. 6. Environmental concerns. Mining certain cryptocurrencies, particularly Bitcoin, requires enormous computing power, raising concerns about high energy consumption and environmental impact. Conclusion. Cryptocurrency has changed the way the world thinks about money, turning a once niche idea into a global financial force that banks, governments, and everyday people can no longer ignore. It offers real innovation, faster transactions, financial access for the unbanked, and a level of transparency traditional systems have never had. But that innovation comes with a trade-off. The same qualities that make crypto exciting, its independence from banks, its volatility, its rapid growth, are exactly what make it risky. There is no safety net, no guaranteed refund, and no way to predict tomorrow's price with certainty. The future of cryptocurrency is still being written. It may become a lasting pillar of global finance, or it may continue to be a high-stakes, high-reward frontier for those willing to take the risk. Either way, one thing is certain. Understanding both the promise and the pitfalls of crypto is the first step toward making a wise decision, not a costly one. As with any investment, never put in more than you can afford to lose.